Today I wanted to run through why we would recommend to some of our clients using all cash to purchase properties all the way up to $4 million, $10 million for primary or secondary homes. So obviously there's plenty of people that are buying $500,000, $400,000 houses in all cash as a way to win deals more times and also close deals quicker. And so those are two kind of clear benefits to using all cash, but that's not the main driver for why we're recommending all cash in some situations for our clients. The biggest reason we're doing so is the tax incentives associated with investment interest expense. And there's some complexity with that, but I'm going to try to break it down in a simple way that can be understood, hopefully, in this video. So to start off with, the mortgage interest deduction is a common deduction most households are taking if they're itemizing in their tax returns. And this just lets you deduct the interest on your mortgage up to $750,000 from your taxes. So in this example, we're using a 6% interest rate. So that amount comes out to about $45,000 that you can deduct. Currently, nothing fancy, mortgage interest expense, simple. And that'll save you about $16,000 in taxes for most of our clients. They're in the 37% tax bracket. So that comes out to about that $16,000. Now, investment interest expense lets you do some fun stuff where you can deduct all of the interest, not just the $45,000. So on your $10 million property at 6%, that's $600,000 in interest that is deductible. Now you have to do a couple things to qualify for that, and that's the whole mechanism of what we're recommending. That is the complex piece of it. But the essence of it is, instead of $45,000 being deductible, $600,000 is, or on a $4 million home, $240,000 is. The numbers get smaller the smaller the home is, but this is even viable on properties at a $1.5 million price tag. So the higher the rate is, like 7% right now, the more valuable this will be because your interest is higher. Your interest expense is going to be higher, and that makes this more valuable. But even at 6%, which is a percent below where we're at for most people right now, this still works very, very well. And then on this $4 million kind of example here, we have the cost of being out of the market at the bottom. We'll get into that in a little bit, but first I want to explain the mechanism. How are we taking the investment interest expense instead of our mortgage interest deduction? So what we do is we use all cash to buy the property. And to do this, our clients are going to have to set aside a certain portion of their portfolio for a couple months to get this done, and we're going to do it with as little tax impact as possible. So we're going to be selling holdings. We're going to be selling ones that are at losses. We're going to be selling some that are at gains. And we're going to do as best possible to have no tax bill as a result of that. Most scenarios we can get pretty close to zero or less than zero. Not always, but most of the time, that is what we are able to do. So once we have that cash set aside in the portfolio, we'll use $4 million for an easy number that lines up with what's on the screen. So we have $4 million in cash sitting in a $10 million portfolio. This $4 million is what we're going to use to buy our property. So we take the cash out of the investment account and then we purchase the home. This is a primary or a secondary home, and we buy it all cash. Then the deal closes. We now own the property, and we have no interest to pay. We have $4 million in equity in the property. We're going to take back out 80% of that value. So we're going to leave in the 20% like you had paid a down payment on a normal mortgage. But then we take the 80% out, and in its place, we put typically an interest-only loan. It can be any loan to get that $3.2 million out, but we like to favor interest-only loans for this. So now we have $3.2 million in cash. What are we going to do with it? Well, to qualify, we have to put that money into an investment. It has to go back into an investment of some kind. Because we just took this money out of the client's portfolio 2 months earlier, it makes sense for us to put it right back into the portfolio because that's where we want to be invested. But realistically, this could be into an investment property, it could be into a business, it could be into all sorts of investments. To keep it easy, we're going to put it back in the portfolio for this example. So now that cash, that loan, has been used to make an investment, all of the interest on that loan qualifies as an expense for investment interest. So it is interest being paid on a loan used for an investment. This lets us deduct not just the $45,000 every year, but it lets us deduct the whole $240,000 or the whole $600,000, depending on how big your loan is. But it lets you deduct the complete interest against your income every single year that the loan is in place. Not just 1 year, every single year. So towards the bottom of the spreadsheet here, we kind of have the difference. So on your $4 million example, you're saving about $100,000 in taxes as a result of the investment interest expense deduction, whereas the mortgage expense deduction is only going to save you about $16,000. Not a small number, but not near as big as it could be. Now, this also makes your tax-adjusted cost of borrowing a lot lower, makes things more affordable for you. That's not the main focus of what we're doing here. That's not the only reason why we're doing it. But it is a nice piece of it and another way to visualize the benefit. So for our $4 million property, we see about $80,000 in just extra value by doing this. Now, of course, at the bottom, you're going to be out of the market for a period of time on a portion of your funds, and there is a real cost to that. We don't know what it will be. We don't know what the market will do for sure. We just use estimates based on historical events. So 8%, we're going to guess 3 months. In a lot of situations, it could be 2. It could be more. 3 feels pretty conservative, pretty safe, pretty standard. So the return in that time would be about 2%, and that comes out to about $80,000, which happens to be really, really close to the year 1 tax savings that we would get from this. But we cannot forget, the tax savings of $100,000 is every single year. The net benefit of $80,000 is every single year, not just year 1. So year 1, we can afford to be negative. We can afford to lose money because we're not in the market and instead we're getting a tax incentive. We can afford to do that because years 2, 3, 4, 5, 6, 7, all of those years, we're still getting some incentive from these taxes, and it's the same amount, but we're not sitting out of the market those years. So we can afford to be negative the first year by a small amount, And it still makes a ton of sense for us to do this in a lot of situations. And yeah, so this is powerful. This is super impactful, and I think there's a lot of clients out there that aren't hearing about this that should be. I think anybody buying a house at $2 million or more should at least be looking at this as a thing that they could do. Yeah, like everybody should be aware of it, even if they're not going to use it. It might not make sense for them to do it, but they should have somebody looking at it. They should have somebody bringing it up and running the analysis to see, is this the right way? Does this align with what we're trying to do for the client? And in a lot of situations, I think it is. Not all the time, but a lot of situations. So hopefully that made sense for whoever's watching. Hopefully this was helpful. Hopefully it gave some insight into some of the things that we're doing and some of the ways you can save money and use your money more effectively to pay less to the government, because nobody likes paying taxes to the government, but we try to do it in the most effective way possible to get the most out of our dollars. And again, the biggest thing is that loan that you take out after using the cash to buy the property has to go into an investment. That's what makes it qualify. The investment at the end makes it all work. Without that, it all falls apart. So that is the key. Make sure that your loan proceeds go into an investment, and then the interest should be deductible. So reach out if there's any questions. Send me an email, text, phone call, whatever. Get in contact with us at Pillar if this sounds interesting. Sounds like something that you haven't been hearing but might apply to you and you want to hear a little bit more. We're happy to talk. We're happy to give some advice. So yeah, let us know. Thanks for watching.